How's that different from what happened in Korea in the last year?
You mean a dramatic weakening of the currency? I think that what happened in Korea had less to do with initially with what was going on in terms of real production and more to do with the structure of financing of that real production in Korea. Korea was a country in which banks had borrowed in dollars short term to finance their lending activities. And when you had the crisis associated with Lehman, bank funding became a big issue. And there was a scramble, right, to try and...
So it was a banking crisis, it was?
It was a crisis associated with the funding. Essentially, you had very high loan-deposit ratios because Korean banks were funding themselves with overseas borrowing, short-term overseas borrowing. As the ability to roll that financing diminished, you had a lot of pressure on Korean won. Yeah? That has since reversed. The other thing to realize, of course, is the won began this position from a very strong, it had seen very sharp appreciation in 2006, 2007. Yeah?
Now, what about the Japanese carry trade?
I mean, when other interest rates are also very low short term, you don't have to borrow in yen. You can borrow in US dollars. And if you think the dollar is going to depreciate relative to other currencies, you have two reasons to borrow. Not only is it cheap in terms of the carry, but you're going to get a capital gain measured in foreign currency.
In the time that the carry trade was important, what did you see happening in the emerging market?
Well, part of the story, there's an element of the picture which is just the same, which was that the growth prospects for Japan were not particularly strong. Yeah? That you had an interesting phenomena where as the growth prospects in Japan improved, Japanese household confidence improved and their willingness to diversify their portfolio overseas improved, which tended to weaken the yen. Yeah? Normally one thinks about strong growth generating inflows and an appreciating currency. In the Japanese environment, strong growth, greater confidence was leading to diversification and a weakening. And so, but interest rates didn't adjust. And in that environment then, when global growth looked very strong, it was advantageous to say, well, here's a currency that's getting weaker and interest rates that are low. I should borrow in this and invest in places where currencies are getting stronger and the growth is generating returns. Is that environment different today? Well, emerging markets relative to Japan, no, that isn't really different. The only issue is that there are other countries where there's a generalized expectation of weakening and interest rates are low. And that includes the United States, which is a marked difference from what we had 2 years ago.
Finally, if you were to look at the next 12 to 18 months and assuming that the economies recover and we get back into a situation where the real economies are functioning again, what are some of the minefields that we need to be mindful of? If you look at the amount of fiscal stimulus that's being generated, not just in the US or China, but in a number of countries, is that something that we need to be concerned about?
Well, the crucial issue is, I think, judgments that investors have to make about the efficacy with which governments will move to reverse the stimulus that they put in place in the extraordinary circumstances generated by the recession. Part of the reason the recession is going to be shorter than many people thought it was going to be was because of the efficacy of the response. And part of that was the magnitude of the fiscal stimulus that was being provided, as well as the magnitude of the cuts in interest rates or the shifts in some instances to quantitative easing. Yeah? There's a risk that policies get it wrong on the other side. I frankly don't think that's particularly likely with regard to monetary policy, in part because some of the programs that were put in place, say, for example, in the United States, are themselves self-limiting. They're not long-term, and they're a function of market demand, and as the market demand falls away, so too will that push on the balance sheet.
Right.
Plus, in the case of the Fed, the mistake that they themselves think they made in monetary policy in the last recession was not to raise interest rates as aggressively as they could have. I doubt they'll make the same mistake 2 times in a row. Usually one learns from their mistakes, especially the one you just made, And therefore, that doesn't seem for me to be the concern. The bigger uncertainty is about the medium-term sustainability of fiscal policy. Yeah. Not so much because of the large deficits we have today, which are a cyclical issue, but rather because of the rise in spending that many governments face as their populations age and the costs of their health benefits, pension benefits rise over the coming decades. That's an issue that we had before, right, that has only been exacerbated by this cyclical problem of deficits.
Well, do you think the rating agencies have been a little bit brutal in reacting to some of the government reactions to the economies to the situation right now? The rating agencies have been threatening to downgrade a number of emerging market countries because of.
Oh, they've been threatening to downgrade the United States, right?
But maybe they should be thinking about. But is that reaction valid at this point?
What the governments need is a credible policy or a credible path for fiscal adjustment that leaves debt at levels that the market is willing to absorb. And what we've seen in the last couple of months, actually, is a rise in long-term yields. That's some combination of changing perceptions about future growth, basically a diminution of the probability of a deep multi-year recession or depression, which would naturally tend to raise interest rates in the longer term. Some concerns about inflation, although the rise, if you look at the rise in the differential for countries that have both nominal and real interest rates, the rise in expected inflation is not that high in many countries, though it has been more volatile. And the other element of the picture is this fiscal concern about the long-term fiscal path. So when you can deal with the growth issues, that's good news, not bad news. With the aspects of expected higher future inflation, that's also in part quantitative easing working. That's what you want to have happen. And that, I think, with responsible monetary policy, doesn't actually turn into actual inflation, right? And then you're left with the question of the sustainable medium-term fiscal path. To some degree, the decision by the regulators to put more focus on that and the consequent rise in interest rates increases the likelihood that governments will take that issue to heart and put together a more credible path, because the economic consequences of not doing it are more real. It's easy to ignore it when the market is ignoring it. When the market isn't ignoring it, when it can turn into a constraint on growth, then it's easier to generate a political will to do something about it.
Given the scope of our conversation and the elements that we've identified, which emerging market countries do you like very much?
In Latin America, it's pretty easy. The most resilient country is Chile. And though the way in which the Brazilians have handled the situation, their natural caution, which they had initially, has been a plus. The countries that are least well positioned, some of them are actually in Latin America, places where macroeconomic policies weren't very coherent to begin with, like Venezuela or Argentina. And the others who are very exposed because of the adjustments that have to happen in balance sheets, be those household or corporate or government, are in Central Europe. I think the other thing that's important are the lessons that emerging market countries draw from the crisis. There is a risk, there is some balance that all countries need to find between using the market to allocate resources and the regulatory structure that they put around those markets. Clearly in the United States, there was too much reliance on market discipline that needs to be tempered.
Yeah.
It's not clear that that's the same approach that needs to operate in many emerging markets. And those that take that approach may be sacrificing growth unnecessarily.
Dr. Hanna, thank you very much for your time.
My pleasure.